Okay, great. So great to see you all. Welcome. My name is Samir Bapat, and from today we are starting a series of around 21 topics. So every weekday 9 to 9:30, I'll be taking one topic which is required uh, to create wealth in stock market. We'll take one topic, and we'll keep some clarification sessions also. I'll be uploading this recordings on YouTube. I'll make a playlist also. So in case you miss attending some sessions, you can as well go back and see the recording. So the continuity is maintained. So let's begin. Thanks a lot for joining on a busy weekday. So let's start. Today's topic is, let me start with the slide. Okay, so today okay, thank you. So topic for today is life cycle of company and what every investor must know. Now why I have taken this topic is there are a lot of confusions, and there are very small things which if a common investor knows, he will not be surprised, because there are many trading strategies also. There are some manipulations also which happen in market because of these things. So if you are aware about these things in a life cycle of the company, then you can as well take the advantage of those things. So let's begin. Can I have yes from all of you? Can I have permission from all of you? Do I have permission from all of you to begin? Can I have yes in the chat box? If possible, please type yes so that I know you are there. Okay, great. Okay, great. Thanks a lot. Thanks a lot for such a wonderful energy. Even you can give thumbs up. If you're not able to type yes, that's good enough. Okay, so now when a company is formed, typically when a company is formed, what we say, a new company is formed, a startup is formed. Nowadays we call a startup, but in the eyes of registration for a company, either it will be a proprietorship or a partnership LLP. Proprietorship is formed by an individual or one family. And typically, if you go in the market, it will be written Agarwal and Sons or Reddy and Sons, like that. So that is a proprietorship company which is owned by a family, and there is no much difference between their assets and the company assets. So it is same. If two different people come together and form a company, like two partners from different families are coming together and forming a company, they can form a partnership firm, which can be partnership firm LLP. So if there is a name LLP at the end of the company, then it is called limited liability partnership firm. Usually all startups will start with the LLP. So they will go for LLP, and it's a limited liability. They are liable. If anything happens, if the company goes bust, then the liability of those people is limited to the money they bring in to form the company. So they start the company, they create a business model, they go to the bank, take some loan, and then increase the business. Business case is formed. Then as the company grows, now we are all very much aware that VCs are there, venture capitalists are there, they do the funding, they become the shareholders, and like that the company grows. Subsequently, when the size of the company becomes big, it is advisable to make it a private limited. It's a private limited company. Now, what is the difference between partnership LLP and private limited? The compliances increases. They have to maintain a lot of documentation, audits, and everything for the private limited company as compared to partnership limited. So this is how the companies are started. I'm just giving how they are starting. I'm not going too much into deep. So again, just for people who joined just now, it will start with proprietorship, partnership LLP, then private limited as the size becomes big. Now, till the private limited, the company is private limited. The people who have started the company, they are called promoters. Now, the promoters or the majority stakeholders can decide who can hold the share of their company and who cannot share. So, whom to give the shares of the company. That is decided by the promoters or the shareholders by themselves. It is no one can just simply walk in and buy the shares. It is decided by the promoters. It is more or less under the control of promoters. Now, hold on, just hold on. Just hold on. Where were we? Okay. Sound is there. So now I'm going to tell. Sound is there, right? Can someone type yes? We are able to hear the sound. Okay, great. Thank you, Anirudh. Now, here one thing interesting which everyone should know is the face value of the share. What is the face value? Let's say, suppose a lot of people must have heard that Sudha Murthy gave 10,000 rupees to Narayan Murthy and he started the company. So that time, maybe 30, 40 years ago, when they started the company, she gave 10,000. His partners might have brought in 10,000 rupees and they all got in 10,000 rupees. They formed a company. Now, let's say if I'm getting 10,000 rupees as a starting money for the company, my partner is also getting the 10,000 rupees to start a company. I'm just giving a simple example. So what we will do is in our documentation, we'll write, okay, we both have brought 10,000 rupees. Each of the partner, because we both are the partners, both are allocated 1,000 shares each of the company for a face value of 10 rupees. That means the share that share of the company, one share is said to be of 10 rupees. Since I brought in 10,000 rupees, I'll get 1,000 shares of 10 rupees each. My partner got 10,000 rupees, so he'll get 1,000 shares. Let's say if I'm bringing 10,000, my partner is getting 20,000. I will get 1,000 shares of 10 rupees each. He will get 2,000 of 10 rupees. So this is the face value when they are forming the company. At the formation of the company, whatever is the value of one share of that company is called face value. This will change from country to country. Normally in India, the face value is 10 rupees. So normally they will start the company with the face value of 10 rupees, and that is how face value comes. Face value is okay. Can I go ahead? Face value, it will play one important role later. So everyone should be clear about the face value. Okay. Just I will show two examples of face value. Here, if we go, see Dynamatic Technologies Limited. Here, now the share price is 3,967 rupees. Okay, as of now. But if you see here, I'll just expand. If you see face value is 10 rupees, right? So here you can see the face value is 10 rupees, but actual current market price is 3,967. So when the company was formed, the one share was 10 rupees. Now that 10 rupees share is worth 3,967 as of now. If you see Paytm current market price is 916, but the face value is 1 rupee. Okay, so the face value is 1 rupee. Current market price is 916. So from where this face value has come? This face value has come at the time of formation of the company. They will decide, okay, what will be our face value, and accordingly it will come. So relatively, if you see Paytm, if we multiply by 10, if you make its face value as 10, the current market price should be 9,000. So we can also assess whether it is, if the valuation is correct or not with reference to face value. It is not a correct valuation to do, but roughly we can know. Okay, so moving forward, then what happens? The company becomes big. They have partners. They are doing business for some time. A company needs to do a business for at least 3 years as a private limited company, whatever product they are giving. So what happens is, at a point, there comes a point where they think we have to become big, we have to grow. Now, when they have to grow, there is a limit up to which banks will give them loan, or they can take from the VCs the amount of money they can take from VCs. So there will be some limit up to which they can do all these things. Now, if they want to grow, they want to expand, they need more funding, they need to go to the public. They have to go to public for funding. That is when the public appearance happens. That is when a public company brings in the IPO. So it is an initial public offer. So IPO is initial public offer, where a company is going to public ki, boss, we have a company, it is running very well for last 3 years. This is our record for 3 years. This is how we are performing. This is our product. This is our vision. This is our mission. That all has to be given in the red herring prospectus. That is mandatory for a company to give. They will go to the public. See, this is our performance for last 3 years. Now we want you to invest in our company. This is the IPO. You have to buy our share at this valuation. Now again, earlier, when I'm talking earlier, that means I remember, I think 95, 96, when my friends used to apply for IPO, there was a euphoria, because in that time there was a rule that you cannot take premium over the face value when you are bringing the IPO. So in 95, 90, I think 94, 95, I remember, even I think till 2003, I think 2000, till 2001, 2 or 3, the rule was there that you cannot take premium above the face value. So imagine Reliance share is trading at 100 rupees. Their subsequent public offer is coming for 10 rupees. So already a share of their company is running at 100 rupees, and another offer, the Reliance is bringing offer with a share price of 10 rupees. So there will be a huge rush to apply for that share, because immediately you are seeing, well, there is a jump. As soon as it is allocation will be done, there will be a jump in the price. So that's why there's that euphoria is still continuing for applying an IPO. Like, people are so excited to, now that advantage is gone. I think Manmohan Singh ji did this change. The government said, okay, you can face value is 10 rupees. You can charge a premium, and let's say even if you are coming up offering the share at a face value of 10, you can add premium to it and give it to the common investor in the IPO for 100 rupees or 200 or 1000 or 2000, whatever you feel your valuation is, you can put that valuation and give that price. So I think 20 years back, they stopped giving at the face value. The IPO stopped coming at face value. They were with the premiums. I may be wrong with the date, but that is how the historical chronology has gone. Now, why IPO? I told, when a company is coming with IPO, it wants fund. It wants investment from the public. The flip side for the promoter is they are giving away the control to the public. They are giving their shares, like their shareholders, they cannot manage who will be their shareholder. Anybody who wants to buy from the market can become their shareholder. Anybody can buy more shares and become a controlling partner also. So that is the risk the promoters are running. But the advantage to promoter is they are getting a lot of bulk money immediately for expansion of their company. Now they have to give the red herring prospectus. They have to give a prospectus for explaining why we are coming with this IPO and all. Now, as a common investor, what is the red flag which you have to see in the red herring prospectus? First red flag is what happens is many times the VCs who have invested in the company, the promoters, instead of taking money from IPO from the public and investing in the company, some portion they say, okay, I have some shares, I will sell away my shares in this IPO. So they are giving away their shares in the IPO. This, as per me, is a red flag, because if you believe in a business, you would not give away with your shares, or the VC who is invested, who believes in your business, will not sell off his shares in the IPO. So if you find abnormal quantity of shares being offloaded, so you have to go through the red herring prospectus, and then you have to see where the entire money is going to go, whether it is going to go in the company, or it is going to, or I am buying the shares from the VCs. They are offloading their shares. If they are offloading their shares, majority of money is going into offloading of their shares. They are coming out of the company in the IPO. I would not invest in that IPO. It is likely to come down. So this is one red flag. Second is you have to definitely see the performance and the future prospects of the company. What happens if IPO is not fully subscribed? Then anyway, the reputation of company goes down. Recently, Adani's FPO was there. It got flopped. It was because of a Hindenburg report. It was undersubscribed. Then big people subscribed, and then he cancelled. Okay, I'm taking back this FPO. It is a second subsequent public offer. So that is the difference between IPO and SPO. So a company can come with IPO when it is going public, and then subsequently it feels that, okay, I want some more money. It can come with a subsequent public offer also, or follow-up public offer can happen. VC is venture capitalists. Okay, so far so good. Are we good? Can I have yes from all of you? Anyone having any question? Good? We are good? Okay, great. So, okay, any questions? I'm allowing you to unmute. You can unmute and ask quickly. We'll take 3 questions if you want, because we'll finish this session in 30 minutes. So, what is follow-up public offer? So, first IPO will come. That is initial public offer. After the offer is subscribed, you get the shares. Then the company starts trading on the stock market. Then a company thinks, okay, theek hai, badhiya hai, our shares are getting traded. Let me come up. Let me collect some more money from public, so they can come with the FPO. Okay, so Aishwarya is asking what are the other red flags. We will cover those red flags in our fundamental analysis. Right now, we are just quickly going through it, because otherwise the time will be extra, right? Yeah, Sheetal, quick question. Okay, so no problem. Okay, so let's proceed. SPO is subsequent public offer. So once you have IPO, after IPO, the company becomes listed company. It is traded on the exchange. After it is listed, it is traded on exchange. Company thinks, okay, let's have one more public offer. Let's give more shares to the public. Let's collect more money. So the SPO will come. Okay. So let's go ahead now. So what happens is, once they come with the IPO, the advantage to the company is they can have money. They will have money from the public. They will have funds. Second advantage is they can issue debentures. Debentures is what? One is they can take loan from the bank. Debentures is they can give debentures wherein they say, okay, if you give me 10,000 rupees, if you buy my debenture of 10,000 rupees, I'll pay you some X amount, some interest on that. So based on the, if the company has a higher quality, the companies of high quality AAA rating, they can afford to give less interest rate. So instead of taking loan from bank, they take loan from the public. So there are two things which is happening here. IPO, companies go to the public, ask them to become their shareholders. When they issue debentures, they are going to public and saying, okay, you are not my shareholder, you become lender to me. So you give money to me, I will repay you after 5 years with some interest. So with the IPO becoming public, the company has two advantages. One, it can take money from public as a shareholder. One, it can take money from public as a lenders in form of issuing the debentures. Okay. Okay. So Redmi Note 9 is saying how it is decided. That company can decide. That is a process. They go through due diligence and then see how much they need to offer to public, how much money they need, like that. That is a complete due diligence process which happens. Okay, so now once the stock is listed, let's say the IPO is there, people subscribe to it, they get the listing, the people got shares in their pocket, it starts trading on the stock exchange. Then, as per the stock exchange, they need to have more documentation. They need to have annual general meeting. They need to call all stakeholders and have the annual general meeting every quarter. Then they need to publish the audited quarterly reports. Every quarter they have to report the quarterly reports, what they have done, what their profit, loss, everything. Audited report they have to present, annual reports they have to present, and they have to disclose what is their shareholding pattern. So this is mandatory for each company to be listed in the stock market. They have to follow this norm. Now, in this, what is our learning? What is important for us is two things. One is AGM and this quarterly report. Every 3 months, they'll publish their quarterly report. These two things are very important as a common investor. I'll tell you why in 2 minutes. So now okay. So in stock market, X is very important. Like we say, no, ex-girlfriend, ex-boyfriend, and X, like that we have. So like X is very important in life of many people. Same way, please remember X is very important in stock market. Oh, sorry, annual general meeting. Yeah. AGM is, sorry, annual general meeting, not quarterly meeting. Yeah. No, AGM is annual general meeting. Yes. Okay, so AGM, doing AGM is important. Yeah. So let's go through it. So AGM is there. So X is very important. So what happens is it's not X, it X. So what happens is when the company is doing business, it will declare dividend. Like during the, I think AGM, it happens quarterly also. Okay, I'm getting confused. Anyway, I'll come. Yeah, a shareholders meeting. Yeah, board. Sorry, yeah. Annual general meeting and board meeting. I was getting confused in that. So board meeting will happen quarterly basis. So now in the board meeting, uh, what will happen is they will decide dividend. Let's say if the company is having profits and they want to share it with the shareholders, if the company owners want to share that profit with shareholders, they'll declare dividend. In the board meeting, it will be declared the dividend. Now, how the dividend will be declared? They will be giving a X date that, okay, the dividend X date is so and so. What is this X date? This X date is the date when on that date there is a company registrar who has the record of the shareholders on that day. So whenever we buy share for taking the delivery, whenever we buy share, it gets delivered to our demat account. So that means in the registrar, company registrar, against our name, that share is written. Okay, this X number of shares is held by Samir Bapat. So in board meeting, they will decide, okay, dividend will be of some X rupees will be paid to our shareholders. Okay, what is the date, cutoff date? X date is something XYZ. Let's take one example. Now, if I see here Infosys, right? And Infosys, if you can see, there is a D at the bottom. Okay, I'll remove other clutter from here. I'll remove this also. Okay, so if I zoom in, if you can see, there is a D written here. Can you see the D here at the bottom? D at the bottom? Yes? Okay, so this is the X date. What will happen is in the board meeting, they will say, okay, we will give dividend. How much is the dividend? Dividend is 18 rupees. Okay, who will get the dividend? The people in the registrar, in the register or registrar, whoever is holding Infosys share in his demat account. So whoever is having Infosys share in his demat account on 25th October. So if you buy on 25th October, you will not get the bonus. Please note, X date is the share should be in your demat account, because if the trading settlement is T plus 1, if you buy on 25th, you will get the share on 26th. Some shares is T plus 2. So if you buy on 25th, in the registrar, your name is not there, you'll not get the bonus. So you have to have that share in your demat. Whoever is having share in his demat account on 25th October is eligible to get 18 rupees bonus. That is the importance of X date in stocks. Clear? X date is clear, because this X date I will bring in one or two more times. You should be very clear what I mean by X date. Can I have yes from all of you if you are clear with the X date? Okay. Now, okay. Now, bonus shares. What happens is company has made profit. Instead of giving dividend, they say, okay, well, let's give bonus share. So bonus share is nothing but the amount it shifts in accounting purposes as a profit from profit account to the shareholders money. That is the change they do, and they will give the bonus. So company can give dividend or it can give bonus shares. So bonus shares, what they will do, they will say, okay, if you are holding 10 shares on X date, then you will get one bonus share. Okay, fine. So what happens is in board meeting, they'll declare, okay, for every 10 shares, you will get one share as a bonus share on the X date. Now what happens is on X date, normally if this bonus shares is declared, then the price of the share on that day falls by 10%. Has anyone observed that suddenly the price of yesterday it was trading at, let's say, 100 rupees. Okay, everyone got one share for free. So it will average out in the stock market, the price will fall by 10%. And people will ask, kya hua yaar? Suddenly why the stock price has gone down by 10%? What has happened? What has happened? Because that was the X date. On the X date, the people got 10 shares. Hence, in the market, it gets adjusted by the traders and the price goes down by 10%. So if the price suddenly goes down by 10% on one fine morning, If the price has gone down by 10%, don't be worried. See if that was the ex date for the issuing of the bonus share or not. Everyone clear about the bonus share and the ex date and the impact of issuing of bonus share on that ex date? Yes? Okay. Split. Now, what is split? Split is nothing but face value. We started with the face value, right? So, if we see with the face value was 10 rupees. Now, company says, okay, I want to split. What happens is if the price goes very high, if the price of a share becomes 20,000, 30,000, less and less people participate in that stock. The liquidity of stock goes down. So company usually, though it is not required, but companies say, okay, let's keep the price of the share at the lesser level so that more common investors are able to participate. More liquidity will be there. So what they do is they split the share. What does the split means? Split is if the face value is 10 rupees, they will make it 5 shares of face value 2. So 10 rupees face value becomes 2 rupees ka 5 shares. That is how the split will happen. So again, on the X date, let's say if some company is splitting its share, they will say, okay, we are splitting the share into 5. So 10 rupees face value will become 2 rupees face value. If the stock market, if the stock is trading for, let's say, 1,000 rupees, if they are splitting 1:5, so face value from 10 rupees, they are reducing to 2 rupees. So every person who is having one share will get 5 shares. Stock is trading at 1,000 rupees. On the X date, what will happen? The price will drop to 200 rupees. And then people will ask on WhatsApp, kya hua, why the price has dropped to 200 suddenly? Because the share has split. Today was the X date. As soon as the X date happened in the registrar, though the share will be received after 5-10 days, but the stocks get corrected on the X date only. Okay, clear about the split? Can I have yes from all of you if you are clear about the split? Okay, so split happens. So this is one split. Okay, so Sheetal is asking, is the ex date informed prior? Yes, this is in the board meeting. They'll declare, okay, we are going to do this thing or so on. So and ex date is this is the ex date. So X date is declared in the board meeting. Board meeting decisions are updated, has to be updated on the NSE website. Okay, so it is declared beforehand. It is not a surprise in any way. But what happens is we should know this X dates because many manipulations, many strategies are worked around on this X dates. Then company might go for a buyback. They want to create like scarcity of their stocks. They will say, okay, we are going for a buyback, and when they are going for a buyback, they have to offer price which is higher than the average 6 monthly average current like 6 month average price. Whatever is the price, they have to offer a higher price for a buyback. Normally it is offered a higher price for a buyback. So they will buy back so that the number of shares in the market will reduce and subsequently the valuation may go up. That is how they do. So this is one thing they do. They do a buyback. Again, the X date you have to apply. And then finally, we have a IPO. Similar to IPO, there is a rights issue that, okay, they will say, okay, rights issue means if you want to buy more shares of my company, if you are a shareholder, then only you are eligible to apply for new shares. Okay, not outsiders are not allowed. Only existing shareholders are allowed to apply for the rights issue. That means whatever shares we are offering, will offer to the shareholders only. Again, the X date will come. So this is what will happen, keep on happening, right? So they will give dividend, bonus share. So after being coming to the public forum, there will be dividend, bonus share, split, buyback, right issues. This will keep happening as the company progresses and grows. Then this happens less, but often happens. There will be mergers of two companies. So again, merger, when it happens, then what happens is one company is merging with other. They will say, okay, this is your valuation, this is my valuation. Okay, you are becoming merging with my company. Finally, is my company's name. So whoever is holding 5 shares of your company will get 1 share of my company. So this is how merger happens. Again, X date happens. Demerger is splitting of companies. Then delisting. Now, many times what happens is the company says, okay, I don't want to be traded in stock market. I am going to delist. So delisting is the stock will not be traded on the stock market. They are coming out of the stock market. It will not be available to trade freely. That is delisting. Normally, there will be lot of fluctuations while before delisting X date. Better to stay away, sell your shares if it is going to get delisted. Sell off your shares, take your money and sit peacefully, because we don't know when it is getting relisted, at what value it might get relisted. It might get relisted at a higher price also, or it might get relisted at a lower price also. So that is relisting. So again, after delisting, they will relist. Now, again, in the journey, like I said, the company can go to the public for becoming the shareholder. They can take their money. Similarly, they sell the debentures. Important date is, normally debentures are for 5 years. So they have to repay the debenture. So that is the lump sum money which will go out of the company. So those years when they have to repay the debentures is also very critical, because that year their profit will also be hit. Or after paying the debentures, the profit will look huge. The next year, the profit may look huge. So if you see suddenly the company has very high profit, just check कि last year उन्होंने debenture repay किया था. So now this year they don't have to repay the debenture. So maybe that's why the profit is looking huge. So this is one thing which you can uh, check for it. Okay, Mala is saying, what is debenture? Debenture is taking loan from the public. So company can issue debentures. They'll give it to public. Okay, you buy my debentures. That means you are lending money to me, like that. Then there are convertible debentures. So what happens is, debentures, I don't know, I have not heard of it lately. Earlier, it was a very prevalent practice. Convertible debentures. So whenever is the date of debentures maturity will come, they will get converted into the shares of the company. Of late, I have not heard of convertible debentures coming in the market, but earlier it was very prevalent. Debentures will get converted into shares, and instead of money, shares will be allocated to the shareholders. So that was one thing which used to happen. Again, whenever this thing happens, the share price will go down in the market. Okay, so as long as company is going fine, it is okay. When the company goes bad, goes in losses, big debts, then it goes starts defaulting the bank loans. Once it starts defaulting the bank loans, the banks will go to National Company Law Tribunal to recovery of their money. So once the company case goes to NCLT, it's a very bad thing for the company also, because there are a lot of procedures. So this is like for the companies which are going bad. If it settlement goes in NCLT, that means the lenders wants the recovery of their money. So that time, if your company is in LCLT, you have to see the annual report that no NCLT or any proceedings are going on, because in that, if the company is shut down or sold to a new buyer, then as a shareholder, you will not get any money. The first money will go to the lenders. Then second, then it will go to the people who have purchased the debentures. Then if any money is left, that will come to shareholders. So if there is any NCLT case, better to stay away from that company, even if it is a penny stock. Usually penny stocks will be having such troubles. Just go and check whether they are having any case in NCLT or not. If they are having, better to stay away, because that penny stock can also become zero. So once in NCLT, either they can recover, they can restructuring of loans can also happen, it can recover also, or take over by another entity will happen. And whenever the company closes, please remember, first, if they have land, a company has a land, if the company has to shut down, the land will be sold. First, money will go to the bank. If something is left, it will go to the people who have purchased the debentures. If after these two repayments, if something else is pending, if some money is left, then only it will come to shareholders. So shareholders, in event of company closure, are the biggest loser. So that is the risk we carry being a shareholder. So that is the complete life cycle of a company, starting from inception till closure, if at all. God forbid this comes, but if it comes, we have to be aware of that. So I hope in this journey, in this short duration journey, okay, we took almost 42 minutes. So I hope you learned new things today. Can I have yes if you have learned some new things today? Okay, great. Okay, great. Thank you. So let's have, if you want to ask any questions, you can go ahead. You can unmute and ask. We have.
Sir, usually during the delisting, why there are various, upper circuit and lower circuits, as you mentioned, there's a lot of volatility.
Uh-huh.
So should we, take participation in those?
See, we are common investor, we are creating wealth. Okay, don't see, there is a very thin line between क्या बोलते हैं, जुआ खेलने में कैसे, like gambling and trading. There is very thin line. So stay away from gambling in stock market. Okay, delisting हो रहा है, बाहर निकल के, there are a lot of good opportunities. Okay.
How do we how do we come to know, like, in which company should we invest,
I will be taking tomorrow, we are doing comparison between property and stock market. Day after tomorrow on Friday night, I'll take you through three concepts, three types of analysis which we need to learn in stock market. So finding out which company to invest into is called fundamental analysis. How do you analyze a company fundamentally? A good company.
Okay.
So in 21 sessions, what I'm starting from today, so we'll have 21 continuous days on the weekday, not Saturday, Sunday. On the weekdays, 21 each day, we'll have 21 sessions. In 3-4 sessions, I'll be explaining how to identify a good company.
Okay. And sir, like you said, the difference between private limited and public limited. So like any partnership firm, normally it starts as a private limited, right?
Yes.
Any company private limited, but if they want, they can make it public limited.
Yes, because ultimately, see, Zerodha has not gone for a public limited. They have not come with a IPO. It is still held by the promoters only. They are huge. They don't want public money. So they are happy. They don't want to, whatever money they are having, they are happy with that. They don't want to come to public and say, okay, why don't you invest in us? When a company wants कि ठीक है मुझे और पैसा चाहिए, there is a limit for banks to also give loan. So banks will say, okay, we can give you this much only. If you want to raise more money, then you have to go to public. So they have to come. So
वो
they come to
promoters ही तो
IPO.
अपना शेयर दे रहे हैं ना पब्लिक को.
हाँ?
वो promoters ही तो अपना शेयर दे रहे हैं पब्लिक
नहीं
को.
अपना शेयर में नहीं दे रहे हैं, वो एडिशनल शेयर्स ऐड कर रहे हैं, मतलब they are creating more shares.
Okay, they create more share company.
What happens is two things may happen, or both the things may happen. One is they are giving their own share to the public. Okay, and second is they are bringing in the public's money and creating more shares. Okay, when you create more shares, you are adding that money into company's money for expansion. When
and
you
if they give their share, it's risky.
हाँ?
अगर वो अपना शेयर दे रहे हैं तो it's risky.
हाँ, तो इसका मतलब उनको खुद के बिजनेस पे भरोसा नहीं है, राइट? इफ ही इज
Yeah.
exiting, he is handing it over to the during IPO. If a promoter or a VC is handing over his
Hmm.
shares to the public and that money is not coming to company, उनको खुद के धंधे पे भरोसा नहीं है, वो खुद बाहर
True.
निकल रहे हैं। तो हम फिर क्यों उस IPO में लगाएं? तो एक रेड हेरिंग
Exactly.
प्रोस्पेक्टस में जो है क्लियरली रहता है कि ये जो पैसा आएगा ये कहाँ लगेगा, कितना पैसा
Hmm.
कहाँ लगेगा। तो उसमें
Okay.
क्लियरली मेंशन रहता है कि इतना परसेंटेज जो है वो प्रमोटर अपना शेयर बेच रहा है, इतना ये बेच रहा है,
अच्छा,
और
वो उसमें
बाकी बचा
मेंशन होता है।
वो उसमें रेड हेरिंग में मेंशन रहता है। तो अगर रेड हेरिंग पढ़ेंगे और हमको ये समझ में आता है कि ये अपने ही शेयर्स बेच रहे हैं, तो इट इज बेटर टू स्टे अवे फ्रॉम दैट। थोड़ा बहुत हो सकता है, सी
हम्म
5-10% इज ओके, बट इफ यू फाइंड कि प्रोपोर्शनेट नहीं है, लाइक
हम्म
बहुत ज्यादा ही ये कुछ हमें पकड़ा के जा रहे हैं, तो इट इज बेटर टू
हम्म
स्टे अवे फ्रॉम दैट IPO, भले ही
ओके।
वो 5 times ओवर सब्सक्राइब क्यों ना हो जाए।
हम्म थैंक यू।
या, ओके, ग्रेट।
Hi, Arun here. I have a
या,
question.
या,
So I actually joined the class a few minutes late. So you were explaining about LLP.
हाँ,
I mean,
हाँ,
like from the venture capital, so that stage, and then private limited, I'm clear. But before that, that LLP, you were saying something like is founders are responsible for such and such. I was not able to get that clearly. So can you please repeat that
see,
point or what?
proprietorship is like if I take a loan, there is a proprietorship. The lowest level is proprietorship. So if a proprietor takes a loan from bank and he does some loss in his company, then even his house can be sold to recover the loan. Okay, so his proprietorship, company and the individual is almost same. That is a proprietorship flaws, but the advantage is documentation is not required, no audit, nothing is required, like very few requirement. Second is partnership LLP. LLP is limited liability partnership. That means if I'm bringing 50 lakh rupees, my partner is bringing 50 lakh rupees, total 1 crore we have invested in LLP. If we take loan from the bank of 5 crores also, the limited liability of the company is limited to 1 crore, which me and my partner have brought in. The bank cannot come and sell my property to recover the money. They have to try to recover the money from the money and the assets which the company has bought. That is called LLP, limited liability partnership. So that is a second level where you need more compliances. The compliances increase because again the risk is more for the lenders. The first proprietorship risk is less for lenders because they can take his home also, his car also. But second LLP, the audit requirements increases. Same private limited, if they go, then again the requirements increases. Their size has increased, requirements of compliance audit increases. That's how it goes.
Thank you so much for
Yeah.
clarifying.
Okay.
I said, Rishabh, this side, one more
Ah,
question. Sir, this is regarding bankruptcy process. You told that first the money goes to lenders, then to debenture
ah,
holders, and to shareholders.
correct.
So, like I money earlier in Diwan Housing Finance,
Ah,
Jet Airways, and Lakshmi Bank. Some.
hmm.
So, how would I, if suppose if I would like to know what is the current process going on, how would I know that what is the process and if whether I'll get some money back from those bankrupt companies?
I think unka process must be going on in NCLT. So you can go to NCLT website and check क्या हो रहा है उनका कौन सा केस चल रहा है.
Okay, sir.
So that is the only case. But if you are a shareholder, बहुत मुश्किल है. Rest assured, you will not get anything. If you get, it's a lottery. I'm sorry to say, but मतलब ये हकीकत है.
I lost around 40,000 like when they went bankrupt in 2021.
Yeah, like it's a big loss, but that is the reality. So once that's why we need to keep eye on the fundamentals also, what is happening to their profit and loss, like that. And that is why fundamental analysis is important. Sheetal is saying, if you miss any class, I'll be uploading this on the YouTube, the complete part of it. I'm recording and I'll be uploading. Okay, great. So thank you so much for your time. I hope today's session had a value addition in your knowledge to stock market. You'll be able to use it someday to earn money. We will develop this on every day. And in 21 days, I hope everyone will have enough knowledge to start investing in stock market with confidence. So thanks a lot. Thank you so much. See you tomorrow at 9 o'clock. We will compare property versus stock shares, how and what is the advantage, disadvantage of both. Thank you. Thank you so much. See you tomorrow at 9.
Thank you, sir.
Thank you.